This is Robert Kraft, and I'm your host on the Planet MicroCap Podcast. And with me today, my guest is Matt Joass. He is the founder and the CIO of Maven Funds based in Sydney, Australia. Matt, good day. I'm sure you get so annoyed from every American always saying that, but I'm going to be one of those. Good day.
That's all good. Thanks, mate. Yeah, good day. Thanks very much for having me on. Very excited to be here.
It's great to have you on, man, and thank you for joining me. I know I was so stoked that you helped me with organizing the actual time because even though I follow professional surfing, so sometimes when the events are on, I sometimes know, but I do appreciate your help on that. Math is not my number one.
Yeah, 100%. The international time zones can be a bit tricky when there's different days involved as well because we live in the future, as you know. But yeah, no, all good.
No, and thanks for joining me. And I have to ask, I'm sure our audience wants to know, how's Australia going right now with the fires? I think you told me offline is that rain cures all at this point.
Yeah, pretty much. It's such a vast area that they were just trying to just protect houses and that type of stuff. They weren't able to really make a dent. But then we had a big dump of rainfall last week, and it's still maybe some more coming. So yeah, hopefully that's bringing it all under control. It's been pretty rough. It's been even like Sydney, Melbourne, just thick smoke, like worse than Beijing in winter kind of thing. And so been a lot of other people losing their houses. So it's been tough.
Damn, man. Well, I'll tell you, everyone here, and myself included, just been thinking about you guys a lot. We talked to a number of Aussies, working here at SNN. So we've just been, I'm happy to hear that you're safe, and hopefully it sounds like there's a light at the end of the tunnel.
Yeah, absolutely. And I appreciate that.
Yeah. So with that, I want to, again, this is your first time on the podcast. And as I do with every guest, I'd love to get your background and really how you got to where you're at today. So from there, take it away, Matt. Let's hear your whole story.
Yeah, I guess kind of the quick version. I grew up in New Zealand, got into investing at quite a young age. So when I was maybe in my mid-teens, was following it, but and then bought my first shares when I was like 18. But didn't have any philosophy. I hadn't discovered like value investing. I was just interested in business and kind of reading the newspaper and seeing what stocks would, what's going on and thinking I knew everything. And then kind of had some good luck at the start, which was probably unlucky because it all came bad after that. So I had a couple of companies, one including like a mining exploration company that went well. And so I'm thinking, yeah, I can do this. And then realized, no, I can't. So by kind of mid-20s, I was kind of like, oh, what is this? What am I doing with this? And then I discovered like value investing and Warren Buffett, which I didn't know how I'd missed before. And that was kind of when I got bit by like the investing bug again.
Well, and not to age you or anything, but what time frame was this? Was around the 2000s or?
Yeah, so the 2003 would be when I first bought my shares and when I was about 18. So yeah, it was coming into like a bull market as well, I guess. And so, different things. Reading online forums and that kind of stuff, you think it's all easy and blind leading the blind sometimes if they're not a good forum. So yeah, that was around the time. And then I guess the GFC was just when I was finishing. I did an honours degree in international business at uni and just kind of finishing that, coming out of that. Was kind of an interesting time to be going out into the world, and that was kind of around that time I started really getting back into it and discovered value investing. Ended up joining a shipping company and going to Copenhagen, Denmark for a few years as an expat. And just before I moved, investing started kind of taking over my life. And when I moved there, it like completely took over my life. I started like an investment club and a company with a friend, and nights and weekends were all investing. And so there, after a couple of years, I kind of thought I should probably do this for my full-time gig, not just nights and weekends. And then had an opportunity. I started writing for Motley Fool Australia, and they had a research analyst role open. So I moved down here to start working for them as a research analyst for a couple of years, then portfolio manager for a couple of years on the service we had here, and then left there just a bit over a year ago and kind of setting up my own shop now, Maven Funds Management. So yeah, it's been a journey.
That's so cool. I mean, that's something I envy about most Australians I talk to is they're very much global citizens. You guys really live all over the world. I mean, especially junior mining. I mean, they're a lot of these guys are going to Argentina for for their mines and stuff.
Yeah.
Even just go to the west coast of Australia. I mean, that's a journey.
Yeah, exactly. That's a long trip. Yeah, I think it makes, and probably New Zealand even more so. Like, it's just such a small country. Most of the news you're reading is international, and yeah, I wanted to like live and work overseas.
New Zealand,
yeah.
New Zealanders.
Yeah, it's okay.
I grouped you. I apologize now.
That's all right.
What a horrible mistake. I will never do that again.
Yeah, no, you Canadians are right. That's all good. Yeah, so yeah, like to yeah, understand the world a bit, and yeah, it all helps, I think.
So when you were getting your start, I mean, were you focused specifically on New Zealand public companies or Australian? I mean, just what was kind of around you and easy, or were you kind of looking globally already?
I guess a bit of both. So when I first started, it was like New Zealand and Australia, and then kind of started looking more globally when I was based in Copenhagen. Coming back to Australia, we were just Australia and New Zealand focused for the service I ran, and I moved back into that niche, I guess, because the small cap world in Australia is so inefficient, and you can meet with the CEOs very easily of all these companies and their competitors and suppliers, and it's just a level of what do they call it, like boot leather research that you can't do as easily with big companies. So still, I follow like the big US companies, particularly because I'm trying to look for like parallels in New Zealand and Australia, or companies that can grow and do similar things. But yeah, so I just focus on Australia and New Zealand now with what we're doing. Yeah.
I mean, what's interesting to me is, and especially I've realized this, or I've seen this in the last couple of years when doing a lot of due diligence on the Australian markets and kind of the ethos of especially microcap investing down there, is that it's part of the core of New Zealanders and Australians. It's like it's like gambling is so. I don't mean to equate it to gambling, but like that's what it is.
So Australians are the biggest gamblers per capita in the world. I think per person is like $800 of losses a year, and that's like every man, woman, and child, and that's losses, not gamblers. So they're it's a big part of the culture for sure, and it definitely spills over to that small and micro cap end. And I'm obviously not a gambler, so I think it's kind of perfect for me. Like, it makes the market kind of quite choppy, and things can go up huge for no good reason. Other things can crash as a result, and it just leads to more inefficiencies. Doesn't always mean cheap. That means like both ways, of course, but it just means there's more like value add, I guess, if you're doing analysis. Yeah.
I did an interview on the Australian markets with a gentleman named Mark Tobin. I think it was about a year ago, maybe a little longer. And we were talking about, sorry, not to dive deep. We're going to get to your investing philosophy in a second. But for me, what was interesting is because with a lot of these Australian companies, you look at these share counts and it's like billions of shares outstanding, and you see the share prices and like
market cap or something.
I mean as a fund manager, I mean, how do you go about navigating these companies, especially when you're looking for parallels in the US? Like, usually you see, and some of these companies are good quality businesses in Australia. It's just kind of the nature of the beast. But when you're talking about looking for parallels in the US, like, you look for some of those in the microcaps, you're like, I don't know.
Yeah, I guess my parallels are probably more the big successful companies. I'm trying to find companies that can get there, but you're right. That's two key differences probably. So it's very easy to issue more shares in Australia and New Zealand, and so it's very common. So companies there's these zombie companies, I call them, where they're just like constantly going along, and you just watch their share count just increase massively. And I think in the US it's a bit harder. You have to have an investment bank involved, et cetera, whereas you can just just at the whim of the company, they can raise more shares. In Australia, it's also, there's a lot of what they call backdoor listings. So like a shell company will get taken over, and that's super common in Australia. So you have these. I just recently went through all of the kind of A to Z. There's about 2,500 companies, and there's some weird stuff, man. There'll be like a software company which also has a mine in Tanzania and also has some biotech assets. So it's like this, like these zombies that have morphed into one and the other, and all the old assets are still there. So it's like, yeah, we're really, we're an enterprise software company with, mining exploration rights that we're trying to do something with. So yeah, it's pretty bizarre, but I think that means that you focus a lot more on how they manage cash and capital allocation, and just avoiding the dilutionary companies will get you probably pretty far.
Gotcha. Well, so let's dig in a little bit. As you said previously, you started Maven Funds. Correct me if I'm wrong. I think you said about a year ago.
Yeah, started building towards. So we're launching actually in the next couple of months. So we just announced that it's happening, and yeah, just in the build stage now. So hopefully
Sweet.
get it all. Yeah.
Cool. So then in the building stage now and eventually launch. What's the firm's investing philosophy then? For when it does launch.
Yeah, I described it with a few kind of pillars. The first being finding monsters. So basically, what we're trying to find is these companies that can be very large, big companies, and trying to find them while they're still small. So you're smiling there. But that name's based on Monster Beverage in the US, which is kind of one of my favorite stories from that book, 100 Baggers. Sorry, I think there's someone testing a fire alarm in the building. That's okay. So yeah, trying to find these small companies that have the ability to grow to be very large companies. And I like that example of Monster Beverage because they don't have to be. I'm not looking for lucky companies, I guess. I'm not looking for some unexpected breakthrough, something that can be seen along the way. So Monster's a pretty simple business. There were many times where it was available at a reasonable valuation, and that's what I'm trying to tie those together. So it's like the core of what we do, and then I guess the rest kind of flows through from that. So yeah, trying to apply another way of thinking is trying to like invest in high growth early stage businesses, but with like a valuation backstop. So trying to like merge those two. I come from a value background. I joined Motley Fool interested in like David Gardner, who's had these amazing, huge, I think he has like 1,000 bagger in Amazon or something, which is just insane. $1,000 becomes like $1 million. And so I'm trying to like marry those two. I don't go as far as him, and he ignores valuation entirely. So I'm trying to like bring it back to merge the two together.
Gotcha.
Yeah.
All right. So what were the other three pillars? Because I know it's finding monsters, and then I believe you said deep research, ownership mindset, and use. So you want to dig into those a little bit too?
Yeah, absolutely. Yeah. So I guess a core part of what we do, we're trying to meet with management, meet with competitor suppliers. We want to really understand those businesses. So we only typically want to hold maybe 15 to 30 companies, so much more concentrated than a typical fund manager. It's very common in Australia for people to hold like 100 companies. We want to only hold a few and just really concentrate into those. And that means doing a lot of work on those companies. So try to meet with management at a minimum, but meet with the competitor suppliers, customers, really build out, does this company have a competitive advantage? Does it have different kind of adjacencies it can expand into? I think a lot of the huge upside that can come in investing comes from a company having a really strong competitive advantage, but then the ability to reinvest into other areas. And we want to understand the business model fundamentally. So that's probably most of my work is just understanding like exactly what the business does, how that flows through, and kind of then how scalable that is. So A2 Milk, which I hold shares in today and held for a long time, is up something like 1,600% or something, so 17 bagger or so. And that is a simple company, similar to Monster Beverage. It makes infant formula as its main product. But that is a business that's super scalable, but doesn't necessarily look like it. If you think about a food company, not normally very scalable, but it's much more like Coca-Cola. It has like a brand that it then gets someone else to produce the formula. So it's super scalable business. So yeah, just trying to understand those. That's a big part of what we call deep research, and then monitoring that all the time and knowing when to sell. So the other two were ownership mindset. That's kind of reflecting me as a manager. I have the majority of my liquid net, personal wealth invested into the fund. Anyone else on the team will be doing the same, and the investing team. And it's also for the clients because we want people to understand their own businesses. It's a really weird abstraction of the share market, I think, where people are like, oh, is it going to go down? And what's going to happen? It's just like, just come back to the businesses you own. I like that analogy people say of, if someone sold their one business and they lived in a small town and they bought shares in 5 to 10 other businesses, you'd think they're pretty diversified, but we don't seem to think that about the stock market for some reason. And I think just focusing on those businesses and how they're performing is like the best way to manage the kind of emotions of the market. And I guess the third is thinking about our companies that we invest in. We want them to have an ownership mindset, so not kind of solving the principal agent problem. Typically, we invest in companies that are founder-led, or where the CEO at least acts like a founder, even if you join later, and ideally holds a good share of the company. You just get better decisions when there's all that alignment between all the levels. And I think that ownership mindset, I think it makes for better clients as well that can stick with it. And so that was a fourth pillar when we talk about you, which means our clients, is finding clients that are aligned with us on that journey. I think I kind of look although I invest in growth companies, I'm quite risk averse. So I try to eliminate all the risk of trying to get a good handle on them before I invest. And it's kind of the same with starting this business. A lot of funds that don't work is when they have clients that aren't aligned with what they're trying to do. So we're not interested in just because I previously had some good returns in another portfolio manager. I'm not interested in people just chasing kind of hot money returns. Really understanding what you own and being able to stick with it. And we'll try and foster that as well by giving more in-depth understanding of what we're buying and why. And I think the clients can do that by understanding that and being invested kind of mentally in those businesses. And then kind of hopefully sharing some knowledge between them. So a lot of our investors will be, business owners or senior executives. They're people that understand industry, or even they just might have a super passionate hobby that can have different things related. I really want to the extent possible, get that kind of network and sharing of knowledge going, because Peter Lynch is another kind of an inspiration of mine, and I think that knowing what you own and what's going on in the world, just keeping an eye open, can be super valuable.
Gotcha. So I wanted to come back to something that you said earlier that I wanted to explore further, and it's the idea of you'd like to focus on the Australian, New Zealand public markets because you like to, especially in microcap, small cap, you want to take advantage of the inefficiencies in that market. How would you say maybe the inefficiencies in the Australian, New Zealand markets are different than, let's say, on the same inefficiencies in small microcap in the US and Canada?
Yeah, I think that comes back to that gambling mindset a bit, where you see these huge runs up and then they tend to crash back down. So I think when they crash back down, it can be a good opportunity. I just think there's a small kind of structural differences. There's also a much longer tail, I think, relatively in Australia. So there's 2,300, 400 listed entities, but everyone only talks about the top 200, the ASX 200 normally, or maybe 500. So there's 1,500 companies that are just completely ignored. They're not even in the main industry, so you have a few large and then this huge tail of small cap companies, and so there just isn't really much institutional coverage of any of them, I think. So that's probably one difference. Maybe relatively, there's a much longer tail. And then I look at New Zealand. If you're an Interactive Brokers client, you can't even invest in New Zealand, which I love because it keeps it out. It's a much smaller market, only about 200 companies, but it's really even less kind of picked over there. So I think that'd be the difference. Also, my personal view is that the research that does come out from at that lower tier is probably lower quality than the US. I'm not sure, maybe it's a more competitive market, but I read some of the kind of third or fourth tier brokerage reports, and they're very shallow, which just means that there's even the people that are looking at them aren't, I don't think, looking at it appropriately. And then I think there has been a persistent inefficiency around software and technology. I think that's starting to change a bit, but basically the dot-com bubble was a big thing here, probably even bigger relatively than in the US. A lot of people got burned. A lot of people just learned not to invest in technology, and thankfully kind of ignored that space for almost 2 decades. And I think some of it's starting to come back, but it's not. People still are a bit kind of service level. They might look at, what does a company report its LTV and CAC to be, but they don't really dig that much deeper. So, just trying to find a way to marry those two, of doing the work and then doing evaluation and digging deep on that side.
No, for sure. I mean, 2 follow-ups to that is, just from researching the space and seeing, it's interesting because when we hear there's 2,300 companies, we're like, as in North America, we're like, oh, nothing. Like, oh, we can, roll through those like nothing. And especially keeping the mindset of how much of an active microcap market, small microcap market there is, in Australia and New Zealand. You're thinking to yourself, okay, well, obviously the cream will always rise to the top, but once people, there must be a collective of people that are constantly probably talking about the companies other than those top 200-300 companies that might potentially drive up the valuations of some of these companies because, oh, here's some other good quality business. So now you see the multiples of these companies kind of skyrocketing. I mean, I'm sure that it's all cyclical, so I'm sure you see that every so often. But I mean, have you experienced that and seen that?
Yeah, definitely. I'd say the thing is that when they get pushed up, a lot of the time it's not, they get pushed way beyond the fundamentals. So that definitely happens, but it tends to be kind of more of a trader mentality, or a very hyper momentum mentality. So you see these, something will come out and get some good news, and then other people jump in and just flies. Like they'll go up, 800% or whatever in a year or something, but then they come crashing back down most of the time. And I always tell companies when I'm talking with them, just focus on the fundamentals until you're, well, forever basically, but focus on the fundamentals and then tell that story rather than trying to do it the other way around. Mm-hmm. I've never seen it work in Australia where a company comes out, like hyper promotes and then is able to do it. Like I don't know, maybe 1 in 1,000 times they actually do that, but every other time they get pumped up, then they get into that loop where they're like being rewarded for that promotional kind of stuff, and then it'll come crashing back. So we had some recent big blow-ups, a couple of companies that would announce a partnership with Amazon, and you're wondering, like, are they just using AWS? Like, there's no partnership with Amazon here. What are you talking about? But they got up to pretty big valuations. And then it all kind of came crashing down, and you go from getting close to, because you can get up to kind of $500 million, $1 billion valuation for some of these microcaps very quickly, and then they kind of hit reality. Yeah. So yeah, I think there's good analysts, but there's just a lot more gambling that fuels it as well. So you do get the cream rising to the top, but they need to be kind of disciplined about it, or else you get these whoop-soaring effect.
And what's so interesting about it too is that the ASX as a regulatory body they're pretty stringent. It's not like they're freewheeling, go do your thing and not really having any kind of checks and balances. I mean, they're very strict about news releases and just really the types of information that public companies are putting out there. So it's pretty interesting that happens.
Yeah, I think there's been a lack of enforcement for quite a long time, and so in the smaller end, a lot of stuff. They might get a letter like, we call it a speeding ticket when the share price has gone up a lot for no reason, and then they roll out some good news. But there wasn't, for a long time, enough follow-up to that from the regulators. I think there's some new people coming into our regulator here, ASIC, who are kind of enforcing that now, and I hope that continues, because it's kind of good for me, obviously, have been inefficient, but it does burn a lot of mum and dad investors as well. Like there's a lot of stories of someone putting all their money into a couple of companies and, getting hyped up by those other people promoting it to them and then just losing everything. So it's it's definitely a positive for it to get it improved over time. And I think they're taking the right steps, but I guess it's just a lack of kind of enforcement. There have been some decent rules, but probably not enough on the follow-up.
And also to quickly follow up, it wasn't that long ago that I would always think of Australia and New Zealand as, junior mining, lithium, and all these different commodities. And it's only been in the last couple of years that I've come across quite a few really interesting tech plays, and the technology that's being developed in Australia and New Zealand is really quite interesting. I mean, you were saying that further.
Yeah, absolutely. So I think I don't do mining exploration at all. I have my fingers burned enough and realize it's not for me. So when I'm going through those, it's like 30-40% of the market I can just cross off. But yeah, you're right. There's this growing kind of generation of software companies. I think that there had been a lot of like well-educated people, and often traditionally, particularly in New Zealand, they would build a business, get it to a few $1 million or tens of millions of dollars, and then sell it to a large international player. And more now they're looking at building it themselves or taking it big. So in New Zealand, we had a company called Xero, which is accounting software, incredible business. And the founder of that business had previously built a couple of businesses and sold them off and, made millions, but not billions. And then decided this time I'm going to follow this all the way through. And that company is now worth, many, many billions of dollars, and is a leader outside of the US. Intuit did a very good defense in the US, so it's a much smaller player there, but leader in Australia, New Zealand, UK, and a lot of other countries globally. So, I think that there's kind of been a recognition now where you can grow these big businesses in Australia, and I think that's starting to flow through. So, and the ASX is very actively courting this, perhaps some would say to their detriment, where they're willing to accept lower quality companies, but that's again part of the beautiful kind of inefficiency. It's you get some companies listing that are pre-revenue, and I probably wouldn't say that's like the appropriate place normally for that to be on a public market, whereas in the US I think you have to have a pretty decent amount of revenue before you list publicly. But yeah, so you get depends, I guess. Yeah, depends on your method of listing. Yeah, so I think it's a bit they've been encouraging like a lot of growth from Israeli tech companies will come and list here, and they're trying to kind of spark like a Nasdaq of the South Pacific, I guess they're calling it. So it's all good for me. Like there are some really good businesses. The other thing is because it's such a small local market, almost all of the software companies I invest in are global from day one because the market here is so small. So there'd be a few that might have a niche that only is defendable here, but typically these companies are global from the start, and that means much more diversified revenue. It means I'm not as exposed to the Australian economy and everything else. So I think at one stage, something like 70-80% of my portfolio companies' revenue came from overseas, not Australia. So yeah, that's, I guess, the other thing, just being a small kind of outward-looking country can lead to that.
Gotcha. All right. So I wanted to kind of dive into some of your blog posts that you posted on both on your website, on the Maven Funds website, and then also your personal website. And one of the posts that I really enjoyed when I read was that, and I quote, "the hidden power of inflection points," end quote. So in there you go through various types of inflection points that you look for in your investing process. So I kind of want to just ask you flat out, what are the few types that you look for and why?
Yeah, I feel like I wish I could take that boat back sometimes because I like expose like so much of what I do. But yeah, so inflection points, basically what I'm trying to find, I want to invest in fast growing businesses, and I think that there's an opportunity for like very rapid share price appreciation. But again, I'm not just buying for hype. So I'm really looking at fundamentals. So I'm looking for a business where the fundamentals are about to get a lot better than they used to be, is the simplest way of putting it, which tends to be this inflection point where something's changing and the future's about to get a whole lot better. So the example I wrote about in depth was a turnaround, because I think that's like a classic example that gets a lot of value investors caught out. So a company that's improving its prospects, a lot of people go way too early, I think. And I think there's a much better sweet spot of waiting for proof that the turnaround's already happened and then buying. Some of the other ones is like a new product or segment that's growing much faster than the old one, so it's kind of hidden. It could be just a hyper growth company where they're just tipping past what's called crossing the chasm, so getting into that early majority. Suddenly you can see this big ramp up. Or a company that's just coming into profitability with a lot of operating leverage. That the fundamentals, I guess if you really were analyzing it properly, it's not that huge a difference, but the way it's perceived by the market's radically different when you suddenly have profits exploding off not that much revenue growth. And there can be other things like a demand side thing where there's a new distribution agreement that can just see sales skyrocket. So I'm just looking for points where the fundamentals, the cash flows of the business are about to get like very different to they have been, because I think it's a point where the market makes mistakes. And I guess my grand theory of investing, I have one approach, but the grand theory is, everything is some misperception of the market or some fault of some kind. If you're a deep value guy, you're doing it because people tend to be too pessimistic towards the bottom. I'm saying that there's a whole lot of these other opportunities, I guess on the growth side, where people don't think about things appropriately. Mm-hmm. And I talk about in there around how we aren't able to think exponentially, because I think that's part of it. We tend to just project linearly from whatever's been happening recently. And I think that means that there's these opportunities where a growing business can be significantly undervalued, even if its multiple is 30 times or whatever. Like traditionally people say that's expensive, but I think it can be super cheap if you look at the cash flows and you're like thinking about that growth appropriately. Right. So yeah, that's what I'm trying to get into.
So then in terms, and as a follow-up to that, I'm curious about your perception then of timing, because when I think of inflection points, and maybe some others' perception who may not be looking at the market on a daily basis, or even microcaps looking for new ideas potentially on a daily basis, they might be thinking to themselves, okay, inflection point investing, I got to go find, I got to put in something in my screens and geez, I just hope my timing is good. So how would you recommend investors understand inflection points in terms of your market timing?
Yeah, and just to emphasize again, it's obviously not. There are some other people who talk about inflection points in a share stock chart. I'm not talking about that.
No, I mean neither.
Yeah, Yeah, yeah. So I think that the market timing aspect is a big part of what I'm looking for. So I'm looking for real world traction to prove that whatever this inflection point's already happened. I'm not trying to like predict that it's going to happen without any evidence for it. And I think that's where a lot of these companies that are selling a great story can kind of catch people out. So it can sometimes be in the fundamentals, so like as in the financials that are reported, because we report here on a quarterly basis for cash flow losing companies on a semi-annual basis. So only twice a year we normally report, which is another difference to the US. But we report quarterly for cash flow burning companies. You can sometimes see it in there, and sometimes the market hasn't been fast enough that that's still an opportunity. But often you kind of need to understand the business enough that you're like ahead of that, I think, if you're going to catch most of the upside, which means doing that deep research that we're trying to do and just really like understand if they might announce a new distribution agreement, for instance, but you need to have a good enough understanding of what that means, what that's likely to flow through to. Is there some way that from publicly available information you can track that and measure it before they announce? Because by the time they announce, it might be too late to catch most of the gains. So I try to find for every company some like alternative data or some alternative metric that is publicly available and that we can like weave together to have our own set of numbers for the business. So yeah, for A2 Milk, I mentioned that before, that was tracking how much of the product was out of stock on shelves, because that was quite a big thing, kind of looking at the expiry dates to figure out how fast they were turning over the product, because that had huge explosive growth and was just always out of stock. For other companies, there was a company called PushPay, which I also still own, which provides software for churches in the US. And it was like looking at how many churches were using that. Again, we could find that out from the Apple App Store and publicly available info. So yeah, it's trying to find some metric that gives you that visibility, how the fundamentals are going before the market is like informed with a lagging indicator of a quarterly, ideally.
Gotcha. Well, you actually gave a couple good, interesting examples there of different types of inflection points that you sometimes look for. I mean, overall, what would you say are the different inflection points that when you're going out looking for potential new investment have provided some successful wins? I'm not, if you want to name names, that's fine, but I'm more looking for the inflection point example itself.
Yeah, I think tipping into profitability is a big one that is now a lot of more people are looking at, I think, but it's still pretty significant. Historically, it's been big. So Xero, that accounting software provider, we held that for a while, but when you could see that it was about 12 months going from it had been like the poster child of people denigrating software because it had been posting a lot of losses. But they're like a classic SaaS company. Those losses were heavy marketing spend for this incredibly sticky, long-lived product. And so, but if you could see it, the economics were getting so good, it was tipping into profit. Over the next, I think it's quadrupled since that point over a couple of years. For an already big company, just because now suddenly the market changes its view on it, right? It's not this loss-making company anymore. It's a brand new company that makes profits, even though it's very different, tiny, the sign from negative to positive is so small and irrelevant really to the cash flows. But so that's a big one. I think the hypergrowth inflection point is a big one for me. So that's a company that is just tipping into that early majority of the market. If you think about, early adopters and early majority, a lot of companies don't make that transition. When they actually have, I think that can be big, because that means they're going to just kind of run the table, or potentially run the table in a market, and that can be years and years of being undervalued. So that's I think the tipping into profit one is good, but you can, if you miss it, then that's kind of it. It doesn't have as much of a flow on. Whereas if you can get something that's going to grow for 10 years at above market rates, that's almost any time you buy that tends to be a pretty good investment. So I think those are pretty big. The new product or segment, I guess all of those. I'm going to go through them all. I don't focus on turnarounds too much. I do kind of look at tech, what I call like a tech turnaround. Was a company that got overhyped in the past, like I talked about, crashed back and then had to rebuild. And often they'll have a new management team. Often that new management team doesn't put out any promotional stuff and they just focus on growing. So that can be a good kind of, if I do turnarounds, it tends to be those. It's not like, some like capital intensive, kind of typical deep value kind of stuff.
Right. Cool. So I wanted to switch gears a little bit to another blog post that you did. And this question's based on that. So the Kiwis, the New Zealanders, they're winning the new space race. Is that what's happening?
Yeah. So
All right.
I'm a huge fan of new technologies and everything. So I try to. That's also what kind of draws me to the style of investing I have. I just love learning about the stuff AI and space technology. And there's a company from New Zealand, founded by a dude from the smallest town in New Zealand, in Invercargill, one of the smallest towns at the bottom of the South Island. So probably one of the furthest south places in the world that people live. And he just, I don't know where this guy came from. I had the pleasure to interview him, and I talked about that on the blog. And he founded a company called Rocket Lab. But growing up, he was making rocket fuel in his backyard shed. He had like a bicycle that was like rocket powered, and he rode that around at like 200 miles an hour. There's like video. It's just crazy. And he had this audacious idea to start a rocket company. This was 10, 12, 15 years ago. And he's actually managed to pull it off. So it doesn't get almost any media attention, which is why I was keen to write about it. But they have much smaller rockets that are made with they have a 3D printed engine, carbon fiber for the main body of the craft. And so they can just basically print these things very quickly. And it's just a radical different approach to space. So they also are launching out of this remote area in New Zealand. They had special government approval. And one of the beauties in New Zealand, it can work very quickly and efficiently. So a special treaty was made with the US so that they could operate there. They're a New Zealand and US company, so the US can claim it as well. And they can launch super frequently. So in the US, I think I put a stat up there when SpaceX wanted to do one of their launches from the US, something like 200 flights had to be diverted or changed. In New Zealand, in this remote area, there's almost no international air traffic, so they have the permission to launch something like every 72 hours.
Wow.
And that gives us huge change in access to space. It's also for these small CubeSat satellites and very small satellites. So historically, satellites went very high up into this geosynchronous orbit. They were huge things, very expensive. Now you can put up this tiny cube, like a 10 by 10 cube, that can have a lot of technology on it and much closer to Earth's orbit, to the Earth, I should say. And so there's this new kind of constellation of these small, cheap satellites going up that I think is going to revolutionize a lot of stuff that we do in space. So SpaceX are doing some of that stuff well. The title, "Are they winning the space race?" was slightly cheeky on my part. I don't think it's like clear cut who is, but I think they're winning their niche very well, which is this small kind of frequent launch thing in a way that SpaceX can't currently do. But SpaceX probably has better economics for a much larger craft, or they're putting up a constellation of 6,000 of these satellites for a whole new internet potentially, which another topic that I'm amazed doesn't get more attention. Like if we have a satellite-based internet that connects every part of the globe at high speeds, it's pretty big change. So I had the pleasure to interview him, and I just like learning about new areas of economics. That was kind of my post. A lot of people talk about the science side of it, but I'm interested in how does the economics work.
Interesting. I mean, so it's not really so much for, human travel. It's more just to launch technology in space, come back down, and just really tackling that niche. That's interesting. I mean,
yeah, he has a line that we don't ship meat, so we don't send people up. He has no interest in doing that, and I think it's also just a really good laser focus on the small segment. Everyone asks them when they're going to build a bigger rocket. They say there's no need because their point is to get your payload to exactly where you want it, which means dedicated launch missions. So I think you can go on there like any of us and could book online space on a rocket. It costs a few $100,000, and you could put up your own little CubeSat. I don't know, that's pretty crazy, kind of democratizing access to space. And it's still very early to figure out all the stuff we can do with that. There's a lot of kind of imagery, monitoring, internet. People are talking about producing things in space because the zero gravity could make things, you can produce things you can't produce on Earth. So yeah, the whole world opening up. And obviously it's super early, it's not listed or public now, but I'm just trying to keep ahead of the curve, I guess.
Gotcha. Very, very interesting. Very interesting. And for full disclosure, are you a shareholder in the private company?
No, I wish. It's all private. Few VC companies. I'm not a shareholder in that one.
Gotcha. So this is one of my favorite questions to ask, and it's coming your way. So, what would you say is an investing experience that impacted you the most in your career?
So it probably would be early on when I lost what to me was a lot of money at the time when I was probably like 19 or 20, just on a bad investment basically. So I had a lot of success before that, thought I knew everything, and then bought this mining exploration company and had a really bad outcome and just realized I didn't know what I was doing. So it really reset me. I kind of came back with much more humility. I had that kind of idea that I wanted to like do my lessons early, but I didn't think it would come that early. But yeah, so that was a big one for me, and just realized I had to have a really good handle on the business itself. I'd really been trading news and just like a lot of newer investors. So yeah, kind of humbling experience. Luckily, I got out of it. That company ended up going bankrupt, so I got out of it before then. But it was kind of reset, and that's when I kind of took a couple of years trying to re-examine things, still kind of dabbling, but that's led me to find value investing in something I could connect instantly with a much more rational view of the markets. So that was probably a big one. And then, not to do too, but some of the other companies I'd had, like A2 Milk that I mentioned that went up a lot, just kind of helped me learn the other side of investing. So being willing to see drawdowns of 30%, 40% in a company you hold when you do have those fundamentals aligned in that conviction in the company. I can see that like the other side of the investing that helped me really like get focused on that approach. There's a lot of stuff people talk now about power laws in investing, and that's actually probably a better way of describing what I'm focusing on monsters. There's very few companies that generate all of the stock market's returns. I think something like 4% of companies generate all of the returns over a long period, and the rest of companies basically destroy value. So trying to find those companies, and those like twin experiences, I guess, is what shaped me.
Oh, what was that phrase of power laws?
Yeah, power law. So power law distribution gets talked a lot about in venture capital, but it's basically this idea. In venture capital, it's very common to think, you plant a lot of seeds and maybe one company is responsible for almost all the returns in a portfolio. But I think that actually applies to everything in business and investing, and it's quite ignored. So Jeff Bezos talks about, I'm pretty sure it's Jeff Bezos, talks about business being like baseball, where but except every now and then you can hit the ball and you get 1,000 runs, instead of 4 with a home run. And I think that is kind of how I think about investing. It's this perfect game, whereas 0 cold strikes, as Buffett would say, and then the potential to hit 1,000 run homer. So I guess that's where I'm trying to focus, is strip out a lot of the stuff that has no chance of doing that and focus into a few good companies that do.
You know what? I really wish baseball itself would incorporate 1,000-run home run. I think it might make everything a little more. And I'm a fan.
Like a little target or something.
Like
on the other side of.
Well, I mean, not to divert too much. This season's going to be very interesting with all the cheating scandals, but we digress. It's funny. Based on your investing experience, it's almost like that first experience was like a self-fulfilling prophecy. It's like, I really should lose.
It was crazy. You're like, maybe it should have supposed to happen, right? I was like, I'm young, and it's the time. I'm gonna take a chance, whatever. And then took the chance, and
I think you might be the only one ever that's been like, I really should lose right now. I'm winning, just winning too much. This is just.
The follies of youth.
I really hope that's not your advice for new investors in the stock market, because I'm about to ask that question. So let's do a full disclosure here. It is not to wish to lose at the beginning.
No.
Always
but if you're
win.
To lose, do it at the beginning.
Yes, exactly.
Do it when you have any money. Don't do it later on. I think advice for new investors would be figuring out, I'd say, sampling widely. So I really went through every style of investing, I think, and tried them all on. And I think there's a lot that I can kind of do okay. So I've kind of done like more deep value stuff. I could probably do okay-ish at it, and kind of classic value. But really just finding something that suits your temperament and interest. What's going to, if you are left alone, you don't have any other responsibilities, what will consume a whole weekend for you reading about and studying and understanding? And that's the style that you should probably follow, because that'll get you ahead of everyone else in the industry. And there's people who love deep value and going through the balance sheet in incredible microscopic detail, and those people should be doing that. They shouldn't be doing what I do and trying to think about new technologies and S-curves of growth and all that type of stuff, and vice versa. So I think finding something that suits you and your temperament, and it might be indexing. Like, for plenty of people, I don't think they should be investing actively in the market. They could just be indexing. So finding what suits you. There's like 1,000 ways to make money. There's a lot of approaches that are bad. So like, don't do those. They have to be like logically consistent with what you do. But yeah, finding something that suits you.
Cool. Well, Matt, with that, where can my audience go and find more information about you and Maven Funds?
Yeah, so my blog, mattjoass.com, mattjoass.com, has all my blogs and writing about all that stuff I talked about. And then mavenfunds.com.au is our website for the fund that we're launching very soon. So if folks can tune in there, we'll be posting more stuff up there as well.
Matt, I'm sad to end the interview. I feel like we could keep going forever here, but alas, I think we're at that point. So, Matt, thank you so much for joining me today. This was really a lot of fun, and good luck with the launch. And I look forward to talking soon when you launch. Let's do it.
Absolutely, awesome. Thanks very much. Real pleasure.
Thank you.